We got a real important concept to talk about today that's going to explain a lot about markets, especially what we're going to see in markets over the next few years. And by the end of this video, you're going to see why we're facing extremes here, both on the bull side and the bear side. And sadly, this is all going to lead into a crash like we've never seen before, but there's an opportunity to make a lot of money too. Now, you guys know I'm a macro guy, right? Well, I'm a momentum guy, but macro guy second. I co-founded the global macro research firm MacroOps. That happened a few years ago, and now we're servicing some of the biggest investors in the world. They're managing billions. So when it comes to macro, we're analyzing this stuff every day for ourselves and our clients. And when it comes to macroeconomic analysis, it pays to know where the money is flowing. That's actually the key to all of it. So investing from a macro standpoint, it's not so much about breaking down a company's financials, though that is important. What's more important is understanding the overall environment, because you want to be investing with the flow of things instead of against them. Just like when markets are crashing and you're trying to buy stocks hoping one is going to buck the trend, your probability of winning is much, much lower, right? It's a much better idea to play with the trend. So that's the whole idea behind macro. Find that huge trend, the trend that encompasses everything, and then find specific vehicles to play within that trend. So as I said, it pays to know where the money is flowing. And the most important player that affects these money flows and therefore affects the market the most is the Federal Reserve. It's just like Stanley Druckenmiller here says, and he's one of the greatest investors of all time, if not the greatest. He used to be Soros's right-hand man before he went off on his own. But he said earnings don't move the overall market. It's the Federal Reserve Board. Focus on the central banks and focus on the movement of liquidity. Most people in the markets are looking for earnings and conventional measures, but it's liquidity that moves markets. Those money flows I'm talking about, that is liquidity. And that's the number one key thing you need to track to understand where markets are going. And once again, who's the main party that influences that liquidity? It's the Federal Reserve. So what we're going to talk about today in this video is a huge change in the Fed that is going to affect everything. This change is going to determine our markets. So let's jump into what's going on. And of course, like we always do, we're using our research from MacroOps. And the title of this report is The Fed's New Reaction Function. Because like I said, things have changed. So all us investors are playing a completely different game today than we were just 12 months ago. And that's because the Fed have changed the rules. So the biggest thing to understand right now is the Fed's new reaction function. And remember what I said in the beginning of this video, this new reaction function is causing extremes in the market. That's what we're going to see. So high peaks and low lows. We're talking big market crash, but let's keep going. So the Fed's job, at least up until this point, has been their dual mandate of keeping unemployment low and prices stable. So they want as many people employed as possible, but they don't want inflation to take off. So that's what they mean by keeping prices stable. So the way they did that is by running a counter-cyclical monetary policy. Basically, they lean against the wind. So long story short, when the economy is running really hot and everything's great, the Fed tries to tighten things up to bring it back down to a normal, steady growth rate. And when things are running too low, like in a recession, they try to loosen everything up, once again, to bring it back up to that steady growth rate. So they're trying to keep everything just lukewarm, not too hot, not too cold. So in more specific terms, when the Fed perceives economic activity to be waning, meaning declining, it attempts to boost output by lowering interest rates, because the Fed controls interest rates, right? They can make them higher or lower. Lower interest rates means easier money for everyone. That means more investment, more spending. It boosts the economy. So they lower those interest rates and try to ease financial conditions. That gives a boost to risk taking. So again, capital expenditures, investment, Ponzi schemes, all that good stuff comes from those lower interest rates and free money. Now on the other side of the coin, when things are too hot and they think unemployment is at a level that could lead to higher inflation, they usually tighten conditions. So they raise interest rates. That way you avoid any super inflationary period, which is bad. So that's how they used to do things, right? That's how it's always been done. But now they're doing the opposite. They have changed their reaction function to the economy. So now instead of running a counter-cyclical policy, which is the one that we just described, which is basically leaning against the wind, now they're running full bore with the wind. What's that mean? Well, it means that now when the economy is hot, the Fed just tries to make it hotter. They just want to make it like the inside of a Hot Pocket that you burn your tongue on every single time. Doesn't matter if you cut it in half, try blowing on it, cut it in pieces. You're always going to burn your tongue. And that's what the Fed wants the economy to be like now. See, all of us know that the Fed has been very dovish during this whole COVID shock, right? They've been real nice. Buying up assets, reducing interest rates, trying to stimulate things. But what most of the market doesn't realize yet, that this reaction function is here to stay. This is going to continue. This free money is too nice. See, the Fed did a big review of their policy approach last year, and they realized finally that their mechanical approach to monetary policy wasn't working, and it hadn't been working for some time. So their whole idea of the dual mandate of keeping unemployment low and inflation low, it just wasn't working. So going forward, they decided they're not going to be mechanistic anymore. They're not going to be looking at employment levels relative to NAIRU. And that is an acronym for the non-accelerating inflation rate of unemployment, which is basically the theoretical level of unemployment below which inflation would be expected to rise. So the NAIRU thing is, hey, we could have this much unemployment, but if we reduce it any further, we might get a lot of inflation. So that's what they were calculating all of this based off for their dual mandate. And I actually don't know if this was pronounced NAIRU, but I don't really care. Sounds a little Indian. So instead, what they're going to do now is practice flexible average inflation targeting. What's this acronym? FAT. Fight. Anyway, what they're basically saying is like, hey guys, so we've kind of been undershooting our inflation target for 2 decades. So as a result, we've kind of sort of been creating unnecessarily high unemployment and plenty of human suffering. So, maybe we're going to let inflation run above a target for a while. Probably a good while too before we even think of letting our foot off the gas. So again, what they were doing before with their inflation targeting wasn't working, just unnecessary. The leaning against the wind. Now they're going to lean with the wind. So this is a massive, massive change. Because the Fed has basically been the party that comes in and stops all the speculation, right? When things are getting too hot in the economy and there's a bubble forming, they're supposed to step in and raise the interest rates and just keep everything from running too hot. And this is why Druckenmiller, again, in the past, he said the best environment for stocks is a very dull, slow economy that the Federal Reserve is trying to get going. Meaning they would lower interest rates to get money flowing so liquidity would be flush, and that's always good for the stock market, as we said in the beginning of this video. But once an economy reaches a certain level of acceleration, the Fed is no longer with you, and you always want the Fed with you because again, they're controlling that liquidity. But this is how it used to work. But now the Fed is with you. They just want to reflate the economy. They want to run inflation above their target. Before they had that target, right? No more than 2% inflation. But now they're willing to just let it run, keep printing, get the inflation going. They want to see how low they can drive unemployment with these tools, with their printing press. So when the Fed was reviewing what they've been doing up until this point, they realized how devastating structurally high unemployment has been for many Americans. So they're like, why do we need to do that? Let's just juice the economy. Let's not be the cause of that anymore. Let's let the things run hot. And the thing is, this is such a big change because this is basically saying when we hit a bubble period and the economy is just doing amazing, the Fed is just going to juice it more instead of before where they would try to slow it down, which is crazy. And it's so crazy that people don't actually believe it just yet. They're skeptical. They're trying to wait and see if the Fed is actually going to do this. Is this what Powell will actually do? If Powell is still there, but they are skeptical, yes. But here's what's exciting for the stock market. In our research at Macros, we believe the US and the global economy as a whole is going to kick into high gear sometime around summer. Of course, barring any crazy events like a dangerous, untreatable mutation of the virus or crab people crawling up from their underground lair, but things are really looking like the economy is going to explode soon, as soon as this whole virus stuff is behind us. Our team's estimates for both growth and inflation are well above everyone else's. And that's because there's going to be a big rebound in domestic demand as well as the significant repair to household balance sheets. So first, take a look at the balance sheets of households. And what we mean by that is how much savings do people have right now? Well, you could see right here from April onwards, they've been saving a lot more money than they had before the pandemic. So there's a total excess savings right now, 1.4 trillion. So the way we look at that in macro land, which is pretty simple, if there's more savings, then people are waiting to spend that, especially when we're coming out of a pandemic. People have been talking about the roaring 20s is going to start this year, and we could very well see it because this savings rate is crazy, especially for Americans in our economy. And people are ready to get out and just blow those dollars. That's why we're saying that the consumer demand is going to explode. Everything is going to be so crazy. It's going to be a lot of fun too. It's probably going to be the most social time of any of our lives. Even for me, I'm about to be out all the time. And even in pre-pandemic times, I usually live my life in a colorless void, talking to myself in an empty room with a camera recording. But everyone's real ready to get wild, and that is going to boost the economy like crazy. So that would have already helped the economy and the earnings of many companies, which would in turn increase the stock market. But now think about the Fed not stepping in to slow it down. It's going to be wild. Now what we got to watch for is whether the Fed actually goes through with what they're saying. Will Powell blink or not when CPI shoots above the magic number? And CPI is how you track inflation. Is he actually going to let it keep running, or will he go back on what they're saying now and increase interest rates? So it's going to be a large determinant of how the second half of 2020 2021 plays out, as well as the year that follows. So I was talking to Alex about this whole thesis just the other day, and we're looking at a situation like the late 90s. And you know how crazy that market was. And we're thinking minimum another 2 years of this bull market, because the market is already strong right now. And then second half of this year, the boom comes, and that should carry us over into 2023 even. And I know it's crazy to think about because we've been in a bull market since '09. It's been so long, but this time is actually different. I know it's dangerous to say that, but the Fed has legit changed. The whole reaction function, the dynamics of the market, it's changed. That's why this is so important to cover. But I know you clicked on this video because I was talking about a crash, and you're saying, okay, AK, you've been talking about the most bullish stuff I've ever heard. Where's the problem here? Well, there is no immediate problem. The problem is in the future, because we know markets don't go straight up forever, right? Even though it kind of feels like that. No, they don't. So this whole thing that's happening, it's about to be great for a few years, but it's also setting us up for disaster. And let me tell you why. So the thing about printing money to juice the market is that it becomes less and less effective over time. Now, during this whole COVID pandemic, the government and the Federal Reserve, they did something amazing, and they actually responded properly, and that's why we saw the rebound in the market. But when we get another shock and another natural slowdown in the economy, is this same playbook going to work? Theoretically, it should not, because every time you try to print your way out of something, it becomes less and less effective. Now, everyone thought that this was the scenario that you couldn't print your way out of, this whole COVID mess. They thought 2008 was the last time you could kick the can down the road. Turns out it wasn't. And now the Fed has decided to print even more when things are great. So when things eventually turn around, what are they going to do? Print even more than they were already printing? Make conditions even easier? They're going to try, but do we think that's going to reverse the market like it used to? Because the whole point of the dual mandate counter-cyclical policy was to plan for those down periods so that we could print and stimulate to bring it back up to the normal average that we want. But now the Fed is accentuating the good times and really leaving nothing for the bad times. So when that big economic and stock crash happens, which it will, they always come. Human nature isn't changing here, markets aren't changing. So when it comes, what are we going to do? It's the out of bullets scenario, but for real this time. And this is where we start leading into all the Ray Dalio research that we covered with how empires fall because they blow up their currency, because they print until it's not worth anything. So in this scenario, if this plays out, does the dollar collapse? It should, right? If you print so much, it will eventually collapse. And then you have kind of a total economic collapse and things are really bad. But maybe we're all on Bitcoin by that point, right? But you can see this shift right now in the Fed is very bullish for the next few years. But we're leading into something that honestly, we don't know what's going to happen, but it's not going to be good. So that's why at Macro Ops, we're constantly analyzing this stuff to see when to move your money out. Because you wouldn't move your money out of the market right now. If we're about to see this massive bull like the late 90s, this is where fortunes are made. But you do got to keep your eye on the exit because you don't want to be one of those bag holders in the collapse. So that's why we're constantly doing this analysis, managing risk. And speaking of managing risk, there's actually a huge stock right now that most people are holding in their portfolios in one way or another. And this stock is about to get smacked. And that's because large changes are happening in the US with how big companies are governed. It's positive in my opinion, but negative for stock prices, especially this particular stock, which we discuss in this video right here. And this is something you definitely want to learn about because it will have a big impact on the majority of our portfolios. Like I said, most of us have exposure to it. So if you want to understand what's going on, definitely click this link right here. So if you want to understand what's going on, definitely click this video right here and I will see you there.